All right, welcome to The Explainer. Today, we're tackling one of the biggest, most devastating financial events in all of modern history, the 1929 stock market crash. And look, this wasn't just some crisis that bankrupted a few wealthy investors. No, this was the spark that ignited a whole decade of global suffering, what we now call the Great Depression.
So to really get a handle on the crash, you gotta understand the decade leading up to it, the Roaring '20s. I mean, it really was this period of just incredible optimism. It felt like the good times, the prosperity, would literally last forever. But, as we're about to see, the very things that made that party so wild were the same things setting the stage for one heck of a disastrous end.
This quote right here from Joseph Kennedy, JFK's father, it just perfectly captures the feeling at the time. The story goes that he realized things were getting out of hand when his shoeshine boys started giving him stock tips, and that was his light bulb moment. He thought, wait a minute, if everyone thinks they're an expert, then this isn't about smart investing anymore. It's just a national gambling craze. And that is a classic warning sign that a bubble is about to pop.
Okay, so to really see how this bubble got so massive, we have to jump in our time machine and rewind. Let's go all the way back to the end of World War I and the start of a totally unprecedented economic boom here in the States.
So the war ends, and America basically emerges as the world's #1 economic superpower. I mean, its factories are running at full steam, just churning out products like crazy. And they're not just for Americans, they're for a Europe that's still trying to rebuild after the devastation. All of this created this massive wave of prosperity that, we now call the Roaring '20s.
So, you might be asking, how did regular folks get tangled up in all this? Well, it's pretty interesting. It actually started with the government selling Liberty bonds to pay for the war. For the very first time, this taught millions of ordinary citizens this amazing concept. You could make your money make more money for you. The banks, of course, they saw this and thought, aha! They started marketing corporate stocks right to the public, promising these steady, reliable returns with hardly any risk. And before you knew it, little brokerage offices were popping up on corners all over the country. It was literally Wall Street coming to Main Street.
And this really gets at a huge shift in the American mindset at the time. This whole boom, it wasn't just about stocks. It was being fueled by this brand new culture of easy credit. For the first time ever, pretty much anyone, from a bank director all the way down to a shoeshiner, could get a loan. You could get a loan for a new car, a radio, and even stocks. It was this whole culture of living way beyond your means, all built on this rock-solid belief that tomorrow was guaranteed to be richer than today.
So you take that easy credit, you mix it with all this public excitement, and you add a booming economy on top. And what do you get? Well, you get the perfect storm, the absolute perfect conditions for a speculative bubble of historic size. One account from the time even called it a financial drunkenness, and that's a pretty great way to put it.
And who was pouring the drinks at this party? Well, that would be the newly created Federal Reserve. See, back in 1922, they slashed interest rates down to these historically low levels. That made it incredibly cheap to borrow money. And this flood of cheap cash, it didn't just get people buying more stuff, it absolutely supercharged the stock market.
Now, the real engine behind this whole frenzy was something called buying on margin. Let me break it down. It basically means you could get a loan directly from your stockbroker to buy stocks. So you'd put down just a little bit of your own cash and the broker would loan you the rest. And hey, as long as the market was going up, it was an absolutely fantastic way to make your profits explode.
But the amount of leverage they were offering, it was just extreme. We're talking a typical ratio of 1 to 10. Think about that for a second. For every $1 of your own money, you could control $10 worth of stock. It's nuts. Some estimates say that 2/3 of all stocks on Wall Street were bought with borrowed money. So this setup was amazing for amplifying your gains. But, and this is the big but, it also meant that even a tiny drop in the stock price could completely wipe you out. And not just wipe you out, but leave you buried in a mountain of debt.
And this right here gets to the absolute heart of the problem. The price that people were paying for stocks became totally disconnected from what the companies were actually worth. Seriously, it didn't matter anymore what a company made or how much profit it turned. The only thing that mattered was that the stock price kept going up. It was a classic feedback loop. Demand was just being fueled by more demand. That's the textbook definition of a speculative bubble.
And there were people who saw this coming. There were warnings. Really respected bankers like Paul Warburg, he saw this financial drunkenness for exactly what it was, and he predicted a colossal collapse. But
In the middle of the Roaring '20s, nobody wanted to hear it. The sources we have say people basically told him to just be quiet. The American dream was going strong, and absolutely no one wanted the music to stop. But like they say, all parties have to end. So now let's zoom in on that one specific week when the music finally stopped, and that American dream turned into an absolute nightmare. It all came crashing down in late October of 1929. It really started with just a tremor. On Wednesday, October 23rd, the market took a pretty sharp dive, about 7%, enough to make investors nervous. But the very next day, the day we now call Black Thursday, that nervousness exploded into outright panic. It unleashed this massive wave of selling that would lead to the final, catastrophic blow the following week. In the scene on Black Thursday, it was just pure pandemonium. In the first few minutes after the opening bell, orders to sell 1 million shares just flooded the system. Prices were plummeting so fast that brokers were practically begging people to buy stocks for 1/3 of their value. And there were no takers. The trading floor just erupted into chaos. Cries, shouts. Meanwhile, huge crowds were gathering outside on Wall Street as these awful rumors started to spread about investors jumping out of skyscrapers. The whole situation got so tense that the NYPD had to be called in to stop riots from breaking out.
Then, in this moment of just unbelievable drama, the titans of Wall Street themselves stepped in. We're talking about a group of the most powerful bankers in the country, a guy from JP Morgan, even the billionaire John D. Rockefeller. They publicly pooled their own money to buy up massive blocks of stock. The whole goal was to show confidence, to try and stop the panic. And for a brief moment, it actually worked. The market rallied. But that little injection of confidence, it just wasn't enough. It was like trying to patch a dam with chewing gum. After that brief recovery, the selling started all over again. And then came Tuesday, October 29th, Black Tuesday. The market plunged another 12%, the single worst day in its history up to that point. The banker's dam had broken. The bubble had officially and just catastrophically burst.
But you see, the crash itself, that wasn't the end of the story. Oh no, it was just the beginning. It was the very first domino to fall in a chain reaction that was about to topple not just the stock market, but the entire American economy.
This lays out the domino effect perfectly. Let's walk through it. First, the market crashes. So all those investors who bought on margin, they're totally wiped out, and they can't pay back their loans. Okay, what happens next? The banks that made those loans start to fail. And when the banks fail, ordinary people who had never even owned a single stock, they lose their entire life savings. With no money left, people stop buying things. And when people stop buying, well, the factories have to shut down, which leads to massive, soaring unemployment. See how it all connects? And the scale of this banking crisis, it's just staggering to think about. In just 2 years following the crash, 3,000 U.S. banks failed. They just went under. Millions of families watched their savings, money they had worked a lifetime to accumulate, just vanish overnight. It's really no wonder people lost all faith in the system and started stuffing what little cash they had left under their mattresses. Now, this crisis wasn't just contained to America's borders. Not at all. At the time, the U.S. was the world's leading economy. So the old saying is true. When America caught a cold, the rest of the world got pneumonia. These shockwaves just radiated outwards, triggering a truly global Great Depression. The economic collapse spread everywhere. Europe, South America, all the way to Australia. England was actually forced off the gold standard, which was a huge deal for the global financial system. Unemployment just skyrocketed across the continent, in places like France and England. But the impact in Germany, that was particularly devastating. The widespread social unrest, the economic desperation, it created this massive political vacuum. And that was the opening a young politician needed to rise to power, promising to restore Germany's strength. And of course, his name was Adolf Hitler. So when you boil it all down, yeah, the mechanics of the crash were financial, but the fuel? That was purely human. The Roaring '20s were powered by optimism and, let's be honest, greed. The crash and the depression that followed were driven by the flip side of that coin, fear and panic. And all of that brings us to a final, really crucial question. Sure, our technology has changed. We've got a lot more regulations now. But has human nature really changed? Have we truly learned the lessons of 1929? Or is the same basic psychology that creates one bubble just destined to create the next one?